We're live. It is Cowboy Metals Live, everyone. Thank you for joining. It is June 7th, 2022, and we will get to the topic here in just a moment where we let everything load. I'm going to do my usual sound check, set the master controls, make sure everything is working. We do have sound good to go. As a reminder, before we get into the content, we have a poll of everybody, and the poll question is silver in a real shortage? The answers are yes, no, in 1 year it will be, or no, there is massive supply. So basically 2 yes answers and 2 no answers, a little bit of nuance to those. I want to see what you guys think. Of course, that will be the topic of our conversation today. And we're going to throw in China in there because it seems to me, based upon the data, China is slowly taking the lead in terms of gold in the international markets. And I'll explain why I believe that. I'll also give you a little bit of an update on 𝙂𝙊𝙇𝘿. Not a whole lot of chunkiness there, but we'll talk about it. Because it's something we talked about in the program quite a bit, and we'll lean into it just a little bit more here for the program. We'll also go over the CME numbers in silver, may do it in gold, but I think we're going to focus a little bit more on the silver for the CME numbers. Welcome everybody to the program. Got about 40 people logged in. Sound is still working. Remember to answer the poll. I'm your host, Rob Keens with 𝙂𝙊𝙇𝙀𝙍. For those of you new to the channel, Tuesday nights, 5:30 p.m. Central Time, we do Cowboy Metals Live. Usually you'll see me don a cowboy hat today. I've got it right back here in the background for you guys as I revamp my background and get that up and running. Remember to answer the poll. And here we go. We're about to get started. Title of today's live stream is China taking the lead in global gold trade, silver to follow. We're also going to talk about whether or not silver is in any sort of supply shortage. I'm arguing it is. Although I've gotten lots of criticism for saying that, both on my channel and on other channels in which I have been a guest. But without further ado, ladies and gentlemen, let's go look at the data, because at the end of the day, that's what we are. We're a data channel, and that's what matters. Here is silver from the CME group, which basically runs the exchanges. And I always look at the volume and OI numbers because that tells you where they're settling. The dominant month, if we go down here to, settlement number. We go down here to settlements. The dominant month right now is July. The next dominant month will be September. You can tell by the trade volumes. Now, on the CME, I'll do quite a bit of a refresher because you guys haven't seen me do this in a while. For both gold and silver, and this is not necessarily true for all our commodities, but specifically for gold and silver, there are dominant trading months, and there are about 6 of the 12 months in each of those markets. Those dominant trading months are where the derivative positions are set, or the paper positions are set. And you can see by looking at the numbers, the estimated volume for July, which is a dominant contract coming up, volume was 51,006. So based on this volume number, it's the most traded month. Now, people can trade further into the future if they want to hedge their price risk further into the future, because that's what derivative markets are for. And so you've got a September contract. And you can go as far in the future as you want. You've got 2,000 contracts for December later in this year, about a half a year away. March of next year, you got 374 contracts that traded yesterday. Now, this is just for one day. It's for Tuesday, June 7th. If we toggle this and go to Monday, you get the numbers for Monday. There's pretty good volume here on Monday for the July contract, and pretty good volume also for September and December. Why does this matter? Well, as people move in and out of positions, the price either rises or falls. And you can tell that by the settlement price. So here in settlement for Monday's data, sorry, we're getting that drop down. Monday, the 6th of June, the average settlement price for these contracts on the dominant month, which would be July, and this is the one where you want to find the spot price, was 22,092. For Tuesday, which is today, the early data, and they'll say last updated here. And since it's same day, they'll update this. It's not exact, but it's pretty close. It's a guesstimation for today. On the July contract, it was 22.17, or rounded up to 0.18. So the prices were going up on the average settlement price. And you can tell how much that's going to move spot by the estimated volume of settled contracts. This number right here tells you how strong a move that is. So that's 51,000 contracts at 22.18, we'll say, in the July month. And that's where spot price will be set, the next nearest dominant month. It won't be set by September. That's not the dominant month. It's too far out to set spot. Friday, June 3rd, you saw it close at 21.908 on the July contract, 38. So we've had both a higher settlement the last 2 trading sessions, and we've had higher volume, which means the market overall and the derivative positions wants to go higher on the silver price, and we have seen a slightly higher silver price as of late. That's how all of that works. And just wanted to point that out to you guys. If we go to volume and OI, you get this nice little chart at the top. It shows how much volume is traded, or how much volume is out there. Open interest, I will say. Volume is the traded. Open interest is how many contracts are there. Volume is how many actually kind of closed in that time period. And when you see this bar go higher on the volume, it means somebody's coming in big, or a collection of people are coming in big and moving the price one way or the other. Typically, when you see these higher bars surrounded by lower bars, it's typically more people going short, because silver is one of the most shorted things on the exchange, and so is gold. So it just happens to be, typically when we see one of these taller bars on the bar chart, they're shorting it. The bullion banks have come in and shorted it. Sometimes the producer merchants to hedge the price risk, but usually it's the bullion banks. So just wanted to re-explain that. Wanted to look at exchange for physical, which is basically arbitrage between the American and London markets. There were 560 contracts as of today. This is Monday, June 6th data. If you look right here, we had 560 exchange for physical contracts. If you go back to Friday, we had 350 exchange for physical. Exchange for physical, as it popped up here, is a trade is privately negotiated and simultaneously exchange of a futures position versus cash position. That means between this market and the market overseas, because market overseas is an OTC privately traded, essentially a cash market. There were 1,140 on last Thursday, and Wednesday there were 1,771. What all of that means is people are playing price arbitrage between different markets. The reason I bring that up is because I'm going to show you the price arbitrage between the COMEX and China later on, and show you that the trend is more up for gold in China than it is in the COMEX. And I'm going to show you that based upon the graph that they have on the Chinese Shanghai Gold Exchange. We'll get to that in a moment, but I wanted to dive into some data real quick about the COMEX. Before I do that, I'm going to check the chat. We're going to see how many people are in. Remember, guys, we have a poll. Please vote in the poll. Do a sound check real quick. Sound is good. Vote in the poll. The poll is silver in a real shortage condition? With 46 votes, 48% of you are saying yes. 20% of you say yes, but in a year it will be. So that's 68% saying yes or pretty soon. The no answers are 24% for a straight no and 9% for no, there's massive supply, meaning there wouldn't be anytime soon. So those that yes and no answer at the bottom are basically time answer if you don't want to say it's in shortage right now, but it could be later, or definitely not ever. That's why I put those for you. Welcome everybody to the program. I see Brad Alboni. I see Caleb Fast. Debbie Cantlon is here. Gerald Liam. We have some new names. Good to see new names on the broadcast. John Bethea, one of our longtime followers, has joined. Thank you, John. Post-pandemic survival is here. Neil Hahn is here. Sean Walker has joined the program. Catfish Customs, which has joined us quite a bit, is here. Mutant Ryaf, who's here all the time. Thank you, Mutant, for joining us. Thank you for the 94, now 95 people who have joined the broadcast. Appreciate you guys being on. Okay, we're going to go back to talking about the markets, why China is taking the lead in global trade. We'll get to that by about the 80% mark of the presentation. I'll get to that for you guys. But let's go back into the COMEX data, because I haven't done this in a while. I want you guys to see what I'm seeing there. All right, here we go. We got that data up on screen. And it's there. All right, we're going to go over to Gold Charts RS, the wonderful service put out by Nick Laird that has historic data on gold silver markets. You can get this data, but you have to pay the COMEX for it quite a lot of money, as I'm told. He basically gets it and is putting it together for years and years and years. And it's a little bit cheaper to get to. This is a paid site, but it's cheaper than going to the COMEX, and he's got more charts. So it's pretty cool. Anyway, I wanted to talk about the change in COMEX silver stockpiles, because the poll question I put up was, is silver in a shortage condition? Well, a shortage, as I define it, is more demand than supply, with the understanding that the long-term supplies are not super robust as they may have been in the past. So in other words, it doesn't mean as of right now we can't find a single ounce of silver. It means we're trending towards, we've had so much more demand than supply the last few years, net. And we've been draining what has been available on a lot of these exchanges and depositories. And so now it's more pressure on the miners to get more just-in-time inventory in the system to feed the beast that needs more silver. Of course, we know silver is used for the military. Got a big military conflict going on. It's used for the space race. US has a space force, and they're building satellites and all that kind of stuff. It's used in medicine. It's used in every electronic, including iPhones. Here's mine right here. Including electric vehicles. With the electric vehicle revolution will come a severe dearth of silver, because silver is used a lot. Why? Because silver has unique properties that no other metal has, and we know what those are and won't cover them, but silver is super important. It's not 100% substitutable by gold, mostly due to price, but also other reasons why. It's not 100% substitutable by aluminum or copper from its conductivity. So, and from its ability to be really stretched thin and applied in minute amounts, silver and gold are very more malleable in that circumstance, a lot of the base metals that are conductive. So silver can't be 100% replaced. Not only that, but I'm hearing word that a lot of the new solar panels that are high output solar panels are using twice as much silver as the older, lower output ones. So a lot more silver is going into each solar panel being produced in the high output ones. So more demand from the solar industry. Okay. Now, if we look at this chart, I got to explain two things for those of you who hadn't followed the program, or, I don't remember from when I used to do this all the time. There's registered and eligible stocks. Eligible on nuclear charts are the light green, registered is the dark green. In terms of what you can actually get immediately off the exchange that we know is liquid, it's the dark green registered, okay? Eligible means private storage. The CME came out last year with a paper that said, we don't know how much eligible actually could come back onto the exchange. It's sitting over in a warehouse. It's privately owned. We can't grab it and force it on the exchange. That private owner's got to do it. And we don't know, because it's sitting in those private vaults, where that's been rehypothecated for other means, meaning, 1 million ounces of it be sitting there for Samsung to use under contract that the COMEX is not aware of, and they don't know. So they came out and said as much as 50% of this light green may not be available, but by their reasoning, it could be 100, it could be 2, it could be 84. They don't know. They're guessing. So when I talk about liquid silver in a shortage condition, I leave it out. I don't talk about it. I just talk about registered. Because could this come back on the market at the right price, assuming it's not already pledged for some other method? Now, remember, more silver is being used and is being put out every year. So to say that a lot of this storage has not already been spoken for in existing applications, industrial and investment, I think would be wrong. I think a lot of it is, and nobody knows the answer to that question because it's private contracts and not reported to the COMEX or publicly because it's private. So I don't care what anybody tells you, nobody knows how much of this light green is available. So we have to assume it's relatively illiquid, okay? It's being held back. It could come back at a higher price. We don't know. So I just look at the dark green because that's what I know. That's the known. Assuming these are correct and their audits are done correctly and they're not lying to us or goofed up the numbers, this is what we have. Now, if we look at about a year and about 2 or 3 months ago, about the time silver squeeze started, we have a lot less available silver on the COMEX. It's liquid, the dark green, okay? We used to have about 150 million ounces. Now we're sitting at some like 80 something million, I think. And there were about 7.5 million ounces that came off last week that moved from registered to eligible, meaning off the exchange for trade and into private hands. Now, could it come back? Maybe. But you can see the overwhelming trend is for this eligible to build up since I've been keeping track of it, dating back to 2000, 20-year chart, about 2002. Actually, let's expand this chart out. Let's do long-term weekly. See if we can get that updated as it's updating. But you can see most of the silver that's been stored on the exchange is stored and it's not going into futures trading. So we can assume that people want more of the silver to be in private storage for particular use, industrial investment, and it's not coming back on the exchange. It's easy. There's some other charts here I wanted you guys to see. Now there's a better chart here. It's a line chart, which shows a difference in eligible over registered and emphasizes my last point. Since 2000, eligible didn't exist. It was all registered. In other words, if there were silver on the exchange, there was no private storage. It was out there for futures trading. But in about 2000, 2001, they changed that and said, well, you can store it in the COMEX warehouse. We'll assume that maybe some of it could come back on the exchange and we're going to track it. And that's why this number goes from 0 to up and then it rises. So over time, you can clearly see more millions of ounces have gone into private storage. That's what this green line is. Less millions of ounces have gone to the exchange. And since silver squeeze, it's almost been cut in half. It's almost like 70 right now, 70 million ounces versus it was almost 160 back when silver squeeze started last year. So most of the liquid silver has come off and it's gone into private storage and it's staying there. That's why I say when it's staying there, it ain't coming off. You cannot assume it's liquid. You have to assume either much higher prices or maybe it's already accounted for and it's not coming off. So that's silver. And if you look at the ETFs and the funds, most of the silver for these ETFs and funds is stored in the UK, not all, but most, especially for SLB, which is the most popular one. So we can tell basically by looking at this chart, we can have a good idea, a good proxy for what's coming out of London. You can see the 4-week change is a negative 9 million ounces of silver coming off the COMEX, 20 million ounces coming out of SLB, and 29 million ounces total. coming out of the ETFs and COMEX, meaning it's not liquid. That's a decrease in available silver. So quite obviously, by the best data that we have, it's not 100% of the data, but the best data we have, we are in a silver shortage condition. We need to define shortage as more demand than supply, and the overall inventories are coming down. Not only the immediate mine output is insufficient, which we know from the Silver Institute, and I've shown that many, many times. The Silver Institute predicted late last year in their November report that would be 110 million ounces short of demand this year. And I think that's before we saw some of the increased investment demand come in the physical. But if we also look at what's going on in the ETFs, it's being drained from the ETFs and COMEX. And if you look at these two little nice charts down here, you can see that there was a buildup of silver ounces held in ETFs, and then it started to fall off. And it started to fall off since the pandemic, and especially within the last year. So this is in dollars and this is in ounces. They've both fallen off. So there's less available silver. Now we're going to go to gold. Different situation. I did say that gold's in a different situation in the pinned chat I put up in the chat box. So those of you that are following on the live chat will know that I believe gold's in a different situation. If you look at eligible versus registered, you have a lot more registered gold available. Now, we were in condition red back in 2020 when the pandemic started. Almost all of it was private storage. Look at this, razor thin available gold. And then what happened was a lot of gold flowed from London to the COMEX to help bail it out. And I suspect, based upon our video series that Daniel and I did on the Perth Mint, some of this came from the Perth Mint, because there was rehypothecated or fractional reserve gold coming from, and silver, coming from the Perth Mint. We don't know how much gold and silver, but total gold and silver together, it was 929 million Australian, I believe, almost $1 billion. And the CEO said it went to a S&P counterparty, which can only be the COMEX or some of these big banks or that type of party. So I think some of the supply came from London, some of it came from Australia, and now you've got healthy gold inventory. So gold is not nearly in as big of a shortage condition. As well, gold is used a lot less industrial as a percentage than silver. So most of above ground is available for investment demand, or for, assuming it's not rehypothecated, pledged out to central banks or pledged out to other contracts. So gold's in a different situation. If we look at the ETFs, however, there has been gold removed. A total of almost 2 million ounces have been removed from the ETFs and COMEX in the last 4 weeks. And so we're now down. And if you look at the long-term charts, we had a little bit of a pop-up and then a come back down. That's in terms of ounces and then value as well. Okay, so gold has come up, but not as much as silver. There's a reason for that. Silver is used more industrially, more of a shortage position than gold. And I think that's pretty clear. I've given you a whole bunch of data. I'm going to pop out of the presentation for a moment, put myself back up on the screen, do a quick audio check. Audio is good. You guys are humming right along. Thank you guys for joining. Ooh, we got 166 users now. Added 70 since I started talking. My good friend Michael, who, by the way, is visiting me down here in Texas, and we were just working out earlier, is riding shotgun. Thank you, Michael, for being channel moderator, and thank you for being down here. Good friend. We went out to dinner last night. Really good guy, and appreciate you being a part of this. All right, poll question. Is silver in a real shortage? 54% say yes, 18% now say no, 26% say in 1 year it will be, 5% say no, there's massive supply. No, there's massive supply, I think, may be the only answer I wouldn't seriously consider, just based on the data I just showed. But I certainly understand people that have that opinion, because everybody's been saying silver shortages forever, and we haven't really got there. I even came on Liberty and Finance a couple of months ago and said condition red on silver, but I was taking the long view and compared with like previous years and previous 10 years. But it didn't mean immediately we're going to run out of retail silver. It's still there. But in the retail market, we see higher premiums. Why? Because of the data I just showed you. There's more demand on silver. All right. Now, the title of this is China taking the lead in global gold trade, silver to follow. That's what we're about to get into now. I did want to give you the COMEX report because you guys love it. That's what originally made me popular on YouTube. I wanted to get back to doing some of that for you guys because I get that question a lot, and it's good to follow. Also, another good source is Michael, our channel moderator, does COMEX reports and APMEX reports as well on his Twitter, which is 𝙂𝙊𝙇𝙬. So go follow his Twitter and you'll get like daily reports on what's going on with COMEX. Very good reports. All right, back to the screen sharing. Here we go. We have data from China. Now, I did say in the beginning, and this is related to gold, gold price was acting differently over the year in China it was in the US. Now, in the US, gold price over the year is about where it was to start the year. Now, the price has come down recently, and then it went up, okay, and then it went down. That was the pattern this year on gold. fact, we can look at it at goldprice.org. Let's do that real quick. So we just look at the last, let's do 6 months on gold. You see it started just under 1800, it's over. So gold's actually doing pretty well to start the year. It started the year about 18 something, went up a little. Silver, beginning of the year, let's do a yearly chart on that bad boy, or I'm sorry, 6 months. Beginning of the year, silver's down a little bit, not much. Now, the stock markets are crashing. Bitcoin has crashed. The crypto complex has crashed. They've corrected 20, 30% in some cases. Bitcoin more than the stock markets. Gold's actually slightly higher than where it was at the beginning of the year, and silver too. But in China, it's a little different. Look at the bigger difference in China. Okay, this is gold in China at the beginning of the year, about right here on the China contract. It's way up. So the price differential in China is much higher. That means China market has different gold pricing throughout the year. There's more demand, the price has gone higher. Now, why is the China data not affecting the world price? Because most of the derivative flow, the paper, the long and short paper, futures and options that help determine futures positions and spot prices that everybody uses to trade gold and silver go through the COMEX and London OTC. I would argue the COMEX probably has more of an effect because there's more data, but it's a collaboration between the London and the US market, the Western markets, the big Western markets. But you can see in China, you get different price action, and China actually delivers more physical gold on these contracts, these positions of traders as a percentage than does either London or the COMEX. So if you're looking for real physical supply price, the world, at least through China, is demanding higher gold prices. Look at the silver benchmark price, and we'll go to a 6-month chart on silver. It takes a minute to load. We'll give it a minute, but it's pretty clear that the prices of the metal are different in the second biggest economy in the world. Now, silver is slightly higher than it was at the beginning of the year. This is the beginning of year price. It's slightly higher. It's gone up, but it's still gone up. And so that's different because the Western price of silver is slightly down year to date since January 1. But in the China market, it's slightly up. But in gold, gold is slightly up in the Western market year to date since January 1. In China, it's way up, much higher percentage up. So the rest of the world values physical gold and silver more than the US and London, which on top of their actual physical trading market sits this massive amount of paper trading, which affects the price in a speculative manner that doesn't reflect the flows. That's why I went back here and showed you the flows. Look at the flows. More being taken off market and kept off market, less available. And silver and gold, a little bit different story, still available, but some still being taken off. And you can see this rise in the stockpiles, the private stockpiles. Okay. I think China's price more accurately reflects in both gold and silver the actual physical demand than the Western markets. The question is, how long will it be before people start following the China price? I've said many times that I believe that China eventually will become a major trading market, and you'll have a bifurcation or a separation of Western gold and silver prices and Chinese gold and silver prices. And you already have seen that here. It just takes more time for people to understand the Chinese market, for them people to say, well, maybe, you know, we want to trade gold in China because we're getting higher prices, and silver in China because we're getting higher and more consistent prices. And they're more of a physical delivery market anyway. I thought that was a good point to make. Another thing I came across when I was researching China was gold trading volume up in China for first quarter. So the first 3 months of the year, it climbed, the central bank said. Gold trading volume on the Shanghai Gold Exchange, which is what I just showed you. This data is from the Shanghai Gold Exchange. The central bank says it went up 2.6% in the first quarter from last year. And the gold trading value on this exchange stood at 3.69 trillion yuan, or about $500 million US. Now, that's a much smaller market than the COMEX or the London markets, but it's still substantial and it's growing. And the point I bring this up is, I think eventually the dominant price is not going to be in one market. You're going to have multiple dominant price trading against each other. There will be trading or arbitrage opportunities between markets. And those trading opportunities, as they become more popular and liquid, will tend to equalize the prices between China and the Western markets, which means longer term, there will be upward price pressures on gold and silver as China becomes a more prominent market. Now, this will take time. It's not going to happen tomorrow. It's not going to happen this year, but it will take time, but it will happen. And it's something I've been calling, and there's a lot of data basically establishing that. Now, for April specifically, it's actually down. This report from the World Gold Council highlights that the Chinese gold trade for April is down. That's not a long-term trend according to the article, because they're pointing out that the shutdowns due to COVID in China are decreasing physical trade volume and physical demand. They think that's such a short-term thing. So it's slightly down for April, but it's up overall in China. And I think the amount of physical trade keeps going up in China. And that's basically what's going to drive that. Another article here, China, and this is interesting, China's getting really involved here in the government helping funding the gold trade, not only gold, but commodities. Remember, the Shanghai Exchange does not only gold and silver, it does a lot of commodities. JP Morgan's been helping China out with this the last few years to build China into a world-class commodities trading market, which just happens to include gold and silver. I reported on that through a series of articles that I published. If you saw me in conference in Idaho at the Silver Symposium last year, by the way, quick shameless plug, I'll be at the Silver Symposium again this year, and I'm going to talk more about gold and silver. If you want to see me, that'll be up actually in Washington State this year. You'll be able to fly into the Spokane Airport and see me. If you want to know how to see Silver Symposium, look it up on Google or go to our LinkedIn feed, and we've got the link there if you want to come see me, as well as a lot of other good people. All right, now back to the article. China sets up giant gold fund to expand its market power. China has set up its largest gold investment fund ever, expected to total 100 billion yuan, which is 16 billion US, aiming to invest in mining projects in the region and enhance Chinese influence in global gold markets, local media reports said Wednesday. The Silk Road Gold Fund, Silk Road's another term for the Belt and Road Initiative I've talked about a lot. It's being led by the Shanghai Gold Exchange. This data we looked at over here and here. As part of China's new Silk Road push to deepen economic ties with other countries in the region, particularly those along the ancient Silk Road trade route linking Eastern and Western Asia. By the way, this Silk Road trade route now connects 73% of the world's GDP, not including the US. The US decided, oh, we don't want to be a part of that because they got the Blue Dot Network. But China's putting together trade routes for 73%. So if you don't think the Shanghai Gold Exchange and the Shanghai Commodities Exchanges aren't going to become more prominent and have more of an effect on commodities prices, including gold and silver, you may not be paying attention to what China's doing behind the scenes with its trading routes and with the exchanges for the markets for the commodities. It says, in fact, the fund's founding late last week took place in Xi'an, the historic starting point of the Silk Road. So symbolically, China's making a statement. Not only physically, but symbolically, China is rising. They're rebuilding the Silk Road even bigger. They're becoming more prominent in the exchanges. And I think the pricing mechanism in the physical trade for gold is shifting, not only for gold, but for other commodities as well, is shifting to China. And that, therefore, is the title of my presentation tonight. The fund may also boost China's power over the world gold market and could increase the use of yuan in pricing gold, the National Business Daily quoted economist Song Qinghui, sorry about that, as saying on Wednesday. In addition to buying stakes in gold mining projects and companies' new Silk Road using private equity and venture capital methods. So not only are they investing in the metals, they're investing in the mines. That's wise. When the second largest economy in the world invests in mines, as an individual investor in the Western markets, you may want to do the same thing because China's signaling gold is more important. We're going to invest in the miners, not only the metal. That's why I have the miners on the program and I talk about them and try to help you pick good companies, at least potentially good targets for you to research. Is because I know this, because it has to come on the ground somewhere. You can't just buy the end metal, and you also get leverage. But more than leverage, when you buy a gold or silver company, you get control of future production, and that's what China is doing here. Brilliant plan by China. China doesn't have their head up their arse like the Western markets do, and you can see it here. The fund may also boost China's power over the world gold market. I already said that. Song said additional funds aimed at the new Silk Road focused on transportation may be set up in the future. All right, so there we go. What about the Western market? So you can't just look at China, you got to look at what's happening in the West. Well, in the West, there's an LME, the London Metal Exchange. That's another commodities market. It abandons the attempt to crack the gold market. Bourse's gold and silver futures expected to stop on July 11th. Goldman Sachs and Morgan Stanley were among the banks involved. So LME tried to set up an alternative market in London to further trade gold specifically, as well as some other commodities. It fell apart. Remember, LME had the nickel one too. And that fell apart. So LME is losing its credibility. And I think London overall in the UK is losing their influence on the gold market specifically, but also on commodities. It says here, the London Metal Exchange will abandon its attempt to break into precious metal trading after just 5 years. The LME, the world's biggest exchange for industrial metals, partnered with banks including Goldman Sachs and Morgan Stanley to launch the contracts in 2017. London's one of the 2 major centers of precious metals trading. I would say 3 now that you have the Shanghai, and even 4 now that France has started their own gold market this last year and is putting in place the computerized systems to allow them to trade. Do not sleep on France, and sure as hell don't sleep on China. Trillions of dollars of gold, silver, associated derivatives change hands each day. And the LME's project sought to move the trade to the exchange comparable to COMEX in New York, providing more transparency over pricing. In other words, they were trying to take it from the London OTC, which we saw the run on last year, and put it into the LME, which would allow an even more ridiculous inflated derivative market. So they were trying to control it by doing a COMEX. That fell apart. Why did it fall apart? Well, LME trade chaos on nickel. We saw what happened in nickel. I think that totally shot the LME's credibility when nickel just exploded and they had to stop trading. And so now the CME is going to get the LME, some of the LME nickel, but that really damaged the London market's ability and credibility, not only in the base metal, but the precious metal market. Where is that going to go? It's going to go to China. Hence the title of the program. All right, we're coming back to see if you guys have questions. I've been over a lot of information. Thank you guys for joining. If you guys remember, super chats are open. You can go down there and make a super chat or put a question, and I will guarantee I'll answer it for you. And I'll try to do some as well from the streaming chat, although that gets pretty busy and sometimes it takes me a long time to find those questions. Commentator says, difficult to watch everybody else make all the right moves. I agree. China's making the right moves. The boneheads in London and the US are making the wrong ones. But the silver lining to that and the positive to that is I think we're going to get better pricing on gold and silver related to the physical trade, and that means prices are going to go up because we saw that in the data I showed you on the Shanghai. So it's coming. Again, all of these things take time to marinate, but I'm telling you, so many things have been changing the last few years, and we'll get into 𝙂𝙊 here in a minute, but so many things have changed in the last few years. It's changing the market. So those of you who've been sitting there waiting for gold and silver to pop know that a lot of things that underlie all of the price controls that we've had over the last, I don't know, 50, 60 years are being changed. It's going to change. It will change. It is a coming. All right. Thank you, Silver Wolf, for joining the chat. Good comment there about gold and silver. Appreciate you being here and appreciate being part of the program. We're going to go back again to the last part of the presentation, which I have to get off of here in about 12 minutes because my very good buddy, Steve Mueller, is going to do a recording with me on uranium. We're going to bring that to you this week. We think the uranium market may be about to heat up. That's a special preview. Steve's going to come and show us his research. So we're going to do about 10 more minutes. We're going to pop off. But I want to show you one more thing with regards to 𝙂𝙊. Now, there's not a lot of chunkiness to 𝙂𝙊 right now, at least publicly, that I can find. Not any of the big analysts in the UK and Europe are talking about it. I can't find a lot of announcements on it. So I'm just going to give you what I got. So this came out in May. I think this came out May 22nd when I was looking on Google and the date that Google dated it, even though I don't see a date here. It was like May 22nd on Google, I believe. The BCBS announces deferral of Basel III implementation. The oversight body of the Basel Committee on Banking Supervision, BCBS, the group of central bank governors and heads of supervision, GHOS, announced a postponement of 1 year to the implementation timeline of outstanding Basel III standards, as you see down here, in order to allow banks and supervisors operational capacity to respond to the immediate financial stability threats resulting from the COVID-19. So COVID-19 is an excuse for the banking system not being solvent and not being able to meet these standards have been out since 2014. It's an excuse. They're not solvent because the world debt system won't let them be solvent because debt is a bunch of crap and there's not enough good high quality liquid assets that the banks can't become solvent. And remember, the Basel standards aren't 100% solvency. It's just upping the game for the banks to be a little bit more liquid to avoid the Lehman style meltdown we had in 2008, 2009, but they can't even get there 8 years later and they're delaying it by 1 more year. So all of these different ones are being delayed by a year. That just came out a few days ago. I have been saying over and over again, Basel will have an impact on the gold market. It'll have an impact on the banking system because Basel encompasses all assets in the banking system, not just gold and silver and those commodities considered as monetary metals. And they can't get there. So that's one of the reasons in which the global system is not as stable as we think, the banking system. And so we're not ready for the repricing of gold and silver, essentially. So it's not happening yet. Some people thought it happened in January this year. I said, hold on, I think they're going to delay some things. They have. So we're not quite there. Here's a press release on 2017 from the reforms. They were trying to finalize it from December 2017. That was linked from this article. This article came out in May. basically stating we're having to delay it. So this has been out for a while. Okay. This part of it for the last 5 years, they're delaying it. They can't get there. They've had plenty of time. So that's your update on 𝙂𝙊. 𝙂𝙊's a mess. As I've said, if they were trying to implement it, it would spike the gold and silver price. It would also show that the banks are not solvent because they can't get there. They don't have enough high quality liquid assets. But it's also, I think, when gold and silver are going to be revalued by the central banking system and the commercial bankers, because gold is considered a high quality liquid asset, silver to a lesser degree, but it's in there, but gold specifically being a monetary metal. And it's there to support the banking system. The central banks have net over the last 11, almost 12 years been buying gold, but they're not ready to reprice it yet because they can't get 𝙂𝙊 to work because it's too restrictive and the banking system is too loose, too much money, too much rehypothecation, too much debt. And that's why it's not working. Thought you guys might like the 𝙂𝙊 update. So I just threw a whole bunch of stuffola into that program. We got back to our roots as a channel. We talked about the COMEX. We talked about why the trade and updated you because I've been talking about this for about a year. And like the only guy talking about this, how China is rising as not only a global superpower, but a commodities trading and a gold and silver trading market, talking about why the Chinese price is different and more responsive and higher in gold and silver than it is in the Western markets, suggesting that the Western markets irrationally suppress it based upon physical demand. I showed you where silver is being run off the COMEX and being put into private storage and may or may not come back. And that's been a 20-year trend, but it has accelerated since silver squeeze of last year. And I talked about a few other things that are important to gold and silver trade. I hope you guys enjoyed that program. Thank you for the 186 people who have been on here. Now, don't leave just yet. I'm going to see if there are any last questions. Ooh, one person left. Don't leave. Don't leave. I'm going to see if there are any last questions I can answer for you, and then we'll pop off here in a couple of minutes. Comment here from Mutant Rife. The bigger problem with China is that so much is now requiring a single person to make the final decision. That's why Johnson lost Vietnam. Good comment. I won't comment on that, but good comment. Like it. A lot of comments about how the CCP is fighting. I agree with you. I think there's a lot there to fight about. It's the second largest economy in the world. They're not all in lockstep in China with a lot of things, but I think they're smart about the commodities markets for sure. Beverly Smith says, will 𝙂𝙊 3 bring about changes? Yeah, I think I answered that question, but I'll say yes, it will bring about changes, but they can't fully implement it. So the price changes in the gold and silver markets that we thought we would see, that upward price pressure hasn't happened because it can't implement all of 𝙂𝙊 3. But that also, the bigger picture is actually affects the banks. This is not just about gold and silver and the NSFR, the net stable funding ratio, in which gold and silver are a part of. It's more about the whole banking system, and the fact that 𝙂𝙊 3 can't be implemented means the banking system itself is not solvent. Now, Thursday, we'll get deeper into that topic when I talk about where we are in terms of the economic crash. I'm going to do a special on that on Thursday, so you guys stay tuned for that. I'm going to get right back into the economic crash and where we are, and I'll mention 𝙂𝙊 as a part of that, as an indicator the Western banking system is not ready. Good question, Beverly. Thank you so much. Will Hong made a good comment. The Fed and U.S. government are discouraging the 60-40 folks to put funds in metals. That's right. 60-40 doesn't work anymore in terms of bond stock portfolio. Portfolio theory has broken down, especially this last year, but last few years, as the stock market hasn't been as frothy and has had a mini correction late 2018, I believe, and now a major correction this year. 60-40 doesn't really work. And yes, the financial people in the Fed don't want you to put it in gold and silver because they want you to have it because they need it for various purposes. Looking back, I don't see any other questions. Didn't see any super chats, guys. One last thing that I wanted to talk to you about that I will get into is where you can go if you're interested in getting the metals. The only person that I advertise and that we have an affiliation with for precious metals deals is ARC Silver. There's a reason for that. Ian is a good friend of mine. We've never had any issues with him in our personal dealings, and I have a lot of satisfied customers. He offers silver and gold cheaper than you can get it elsewhere. He does that by being a small business, being aggressive on pricing, and not carrying everything, just carrying what he can get you deals on. So he doesn't offer silver eagles at $10 over spot because that's not his business. His business is finding the cheapest gold and silver he can. So if you want to deal with him, you go to my site, goldsilverpros.com. You go down here and click on precious metals deals. And then you click on this link right here, which opens up a form. And then you put in your information, your name, email, phone number, and what you're looking for. They'll get back to you within 48 hours. Remember to whitelist invest@arcsilver.com, which is where Ian will email you back from, invest@arcsilver.com. If you can't reach you by email, he'll text you and it'll come from this number. So whitelist this number as well. If you can't reach it by email, or if that email goes to spam, because you haven't whitelisted or set him up as a contact. He may follow up with a text. He won't call you, but he'll follow up with a text. Those are the two methods. So be sure to include all of this information. He'll follow up with you. Now, what does he have? He has lots of deals. The two that are always advertised on his page are the 1,000-ounce COMEX bars. I bought one last year, and you'll see my video down here, the unboxing right here. I did a video on that last October, and we did a trick or treat because it's right near Halloween. And you can see the 1,000-ounce or the 994-ounce bar I got from Korea Zinc. In any case, he still offers those $1.45 per spot. It's cheaper than you get just about anywhere. And he has it drop shipped from the depository to you. It's very safe, using the right secure packaging with insurance from the provider, and $1.29 per spot for candy $0.50. That's 40% silver. That's constitutional silver. He has other deals that aren't listed here. Fill out the form on my website. You can get those deals. And the one guarantee I'll make to you, if he cannot get silver cheaper than other people on certain items, not on everything, but on the stuff that he stocks, email me and I'll figure out another place you can get it. But on the stuff he stocks, he'll beat the price pretty handily. And he does that to help you guys. He wants to get silver in the hands of people cheaply. And, you know, like I said, I bought the 1,000-ounce bar. I've got kilo bars from him. It's a really good provider, the only one that we recommend. So wanted to throw that out there. Thank you to the 186 people who stuck with us for the presentation. That's going to wrap it up. This has been Rob Keen's Gold Silver Pros. We broadcast from a great state of Texas. This is Cowboy Metals. We take no BS. We tell you the data and the facts. I think we had a lot of that today. Remember, stay tuned Thursday when I tell you where we are, in my opinion, in the next crash, the next financial crisis. I'll try to bring you some data and some timelines and things like that. And we'll do that Thursday. And then the uranium report will be upcoming with Steve as well. We're about to actually jump off and go record that and have that for you guys who are following the uranium market, which is in a nice little bull market for you guys. If you're looking for the returns on your stock portfolio, uranium may be one of the things you want to take a look at. Thank you, everybody, for joining the program. Till next time, this is Rob Keen's Gold Silver Pros.